So this is weekly commentary 37. Now let's touch on the monthly chart before we go on to the weekly, daily to intraday, because I want to touch on the importance of that FOMC event that occurred on the Wednesday. But right now, right, so we have this candles high here, and there's many people anticipating a high. This is the high for the DXY. Now, I want you guys, right, let me zoom out for you. Look at the swing highs. Look at this high. Look at this high. Look at this high. These highs. This high. And look at this high. You see that 3 bar pattern that I showed you guys? This, right? This is how these highs are forming, right? So look, this candle, right? Let's just zoom in. This candle, right? This candle's the high, right? Now this candle represents the candle on the left. This is the top middle candle, and this is the candle on the right. And that indicates a swing high. Likewise, the same for this. This is the candle on the left, the candle in the middle, the candle on the right. And likewise, one, two, three, right? One, two, three. Now, there is a reason why swing highs occur like this, right? Now, we can see there's a clear difference between how this has topped and this, why we can anticipate this not to be the top. We'll touch on that in a second, right? Why does it top like this? All of these candles highs have buy side liquidity resting above them. You have to view it through the lens of open, high, low, and close. The high and the low of every single candle has buy and sell side liquidity, especially this is the monthly chart. Why is the middle candle the one that is the highest, right? It's not, oh, because it's in the middle. This is a sweep on this candle's high, and this candle is displacement away from the sweep on those buy stops. Let's look at it in, fruition. This candle had a high. This candle ran that candle's high into this candle's rejection block, and this candle displaced lower. That is why that 3 bar pattern works, and that is how the markets usually top. Right now, look at here, another swing high. We had this monthly candle, right? This one sweeps it and displaces away in one candle, right? This one retraces and then the move away from it. Now, look at this. This candle, right? Yes, we swept it, but now we are just, look at the size of the candles moving away. It's that time of year. Remember a few weekly commentaries ago we said we're running the last move on the higher time frame. We are pairing it with time of the year. And the time of the year that's coming to us in December, right? The end of November is the last kick of the market. And we'll touch on why with the Forex Factory Canada. This is going to be US elections and CPI. Look at these highs. Can you connect a trend line like this across the highs? Yes, you can. What does that tell us? It is a buy side liquidity pool being built up, right? Now, if I remove these again, this candle, right, it rebalanced this candle immediately. Now, it's early on in the month of November, and we've already traded lower. We have elections, CPI, and there's still the remaining news events for the end of the month as well. For the top on the DXY, I want to see the same thing like this, right? On the monthly chart. I want to see a candle going up and then the 3 bar pattern. Sweep and the displacement away lower. Now, that technical, that 3 bar swing high that I'm looking for on the monthly chart of the DXY, that has to be in line with a specific macro. There has to be a specific reason for that 3 bar swing to make sense with a real world current affair. For example, maybe a chance in the interest rates, maybe a black swan event occurs, whatever. There has to be a fundamental context for the monthly chart for that swing high to make sense. This to me is not the top of the DXY. Now, if we go on the weekly, last week we anticipated the likelihood of it being a week where we move higher rather than lower, and the reason is because of this, right? If we go to the daily chart, Last week we swept these lows right here, right? And we came up here. And in the last weekly commentary to this one, the one prior, number 36, this is number 37, we said that depending on how we move into this fair value gap is going to set the tone for if we move higher up into the range, right? Now, we moved into that fair value gap on the Monday, and what did the Tuesday show? The Tuesday showed it go down and then it came back up, disrespecting and not recognizing that as a bearish price array. So what did we know that was going to likely happen with the end of the week? Push up higher. Friday, NFP day, this was one big move, right? That ended a very strong week, turning it into a doji candle in a sense. Now, we are still inside of a consolidation. You see how we swept this low and then we moved higher? Now, understanding the consolidation, this sweep inside of the consolidation, you see this low is inside of this consolidation. Once we sweep that low, we can expect a move to where? The upper range of the consolidation, right? Now, I was hoping that we could at least take out this buy side liquidity pool here, right? But it's still inside of a consolidation. So what did I tell you guys to do? You don't hold and expect for the external range being this high, right? You're working your way to the upper bound of the consolidation, right? Now, what do we have next week for the USD? We have this, right? It's election time for the US economy. Now, this is specifically for, of course, the USD and the S&P 500, the stock market. This brings a large ruckus to the market. It's a time where I consider people, if you, for the people that are funded here and the people that prefer their personal accounts, switch to a demo account and thank me later. There is a way to keep consistency and longevity in this game, and it is not by trading live funds all year round. Me, myself, I've openly said I have switched to paper. I've switched to a demo account. That was from 3 weeks ago, 2 weeks prior to FOMC when that consolidation started. Why? Because you guys need to understand there is difference between a high probability setup and a high probability condition of the market, right? This is not a high probability condition in the market. Why? Because it's a consolidation, right? The moves, they reverse very quickly. You move to the top of the range and look at that reversal, right? You move to the bottom of the range and then we moved up, right? Now, I have this candle marked out. This is an order block. Now, this was a run on sell side liquidity. This down candle ran sell side liquidity and we displaced away. One, two, three, four, five, 6 candles displaced away, right? This shows that this is what? An order block. Now, I want to see the respect of this candle. I don't want to see this candle be traded through. If I see the willingness to trade underneath this candle, this is where my attention is going to immediately, right? Now, we have this sell side liquidity pool here, and this low, and we have this buy side liquidity pool. It's both sides of the markets. This is why there is an uncertainty of which way is it more favorable to trade towards, because there is opposing liquidity pools on both sides. Do you see the point I'm trying to make? You can only have a high probability condition, right? If you can sieve out there is a greater willingness, and take a note of this, is there a greater willingness to trade in one way over the other way? If there is, and you have clear conviction for it, that is an indication of a high probability environment slash condition. Inside of that high probability environment and condition, you are then using what I've taught you in chapters 2, 3, 4 to hunt for high probability day trade setups. Without the first one, the high probability condition, the environment for it, is there, a clear way that the market is going to pull towards? You are not in a clear environment to trade. That's when I recommend switch to paper, trade the range, or reduce your risk immensely to a point where you lose and it doesn't really affect you, right? These are the times on the market you have to weather them out. People blow their accounts in these conditions. And I'm telling you this because I don't want you guys to be, you know, in that statistic. The reason they blow their accounts to it is because the market in the consolidation is designed to do that. It is designed to accumulate orders. This is the reason it brings sentiment. Look at it. The DXY is consolidating up until FOMC. There was NFP. There is CPI next week, and the Congress elections as well. That is a lot of uncertainty, right? Given the technical of a consolidation, it is a pure accumulation time of year, right? So if you're trading live funds, I recommend, consider a paper account. For the people that want to take a funded challenge, I recommend hold it till the next year. There is no harm in sharpening your skills. There's no harm in studying more and preparing yourself more for the funded challenge. See it like an extension on your exam, your university exam, your A-level exam. You have an extension. You have a reason now to not take it, and you have a reason to study and prepare longer for the next year, right? Now, what am I expecting? I'm not expecting this candle to get traded beneath. Now, Tuesday is the election, right? Now, we came up to the range and we displaced. Now, if we take this, right, from this candle's low to this candle's high, and I use the OTE template, we are coming into we're inside optimal trade entry, and this is the sweet spot 705, right? So we've offered that retracement. Now, if we see, the willingness from this area to, move away and reprice higher, the area I'm expecting to reprice is above these candles highs, right? This candle, if we break, the low of the candle, I'm going to have my eyes on this area here. That does not mean I become bearish on the DXY. It is a correction on a higher time frame. Now that correction on the high time frame, the move from here to here on the daily, is going to offer plenty of short positions on the 5 to 15-minute chart every single day. And I would hunt that going into this area. But remember what I said at the start of this video. The market does not top like how it's topped right now on the monthly chart. And we're going to discuss more on how markets top uh, when I look at the FOMC on a 15-minute chart and this weekly commentary. For the people that attended the Zoom on FOMC, there was quite a few of you. I discussed there how we expect markets to top, and it's with the formation of a breaker, right? Now, if we go to the US 10-year, we can see that the US 10-year as well is likely to make a run higher, right? Let's remove that. That was for Zoom. If we look at the weekly chart for the US 10-year, we see that there's a greater move higher. That's the market is probably going to pull towards higher prices over lower prices. This candle's low is lower than this one and this one. That's a swing low, right? Now, can we get the push above it, right? And we have the elections coming up and the CPI next week as well. CPI relates to what from chapter 5? The inflation. And that is, what this market is outlining to us. This technical of the US 10-year, the US 30, but the DXY is consolidating. That is how you need to use your intermarket analysis. That's why I'm favoring higher prices over lower prices on the DXY. It's the bond market that's telling me it, right? Now, if we look at the euro, it's very consolidated, right? If you go on the daily chart, it's the same as the DXY, right? We had that move, we had this run on this high here. Now we're inside this daily order block, right? You see how the DXY has overshot into it a little bit, and Euro USD has just gone here into it, right? Now, I want to see the opposite of the DXY and the Euro. So I want to see this candle get treated as a bearish order block, and I want to see the move down lower, right? The first candle I'll consider is this candle, the move down, and then consider this low, and then work towards these lows here, right? This retail view this as a trend line. There's many willing sell stops resting beneath this trend line, in the idea of if we break out of this trend line on the downside, they would, want to enter sell positions. There is many sell side liquidity pools that rest beneath that trend line. Now, this week as well, if we go back to Forex Factory, you're going to see this, right? The daylight is called the DST shift, daylight saving time shift. The UK, for the people that are in the UK with me, we had the hour go back last week. Now, America didn't change their hour on it's going to change today, right? That caused a discrepancy in our trading because now the kill zone and every single time aspect has to move an hour back if you're looking at it in UK time, right? So instead of, a 7 to 10, it will be a 6 to 9 until the hour now goes back. So now the hour is going back for America. The same time aspects that we're considering, they're going to go back to what they were. It was just this week. Now, I want to touch on FOMC and I wanted to show you guys why trading the FOMC is, it's not the smartest thing to trade. If we just delineate the days like how we usually do. So this is Wednesday, right? Now let's look at Wednesday on a 5 minute chart. Now we were watching this together on the Zoom, right? The whole entire FOMC event. Now the FOMC event, there was the FOMC rate and then there was the meeting. So it was a two-part news event. It is very likely when that happens, there is a Judas swing with the one part and then the actual real intended move with the other part. And that's what we got in this FOMC from last Wednesday. Now, this is what I want to explain to you guys how markets top. This, right? This is not how markets top. You see this move down lower here, this entire move. This is designed to catch retail out. Look at all these sell side liquidity pools, right? If you go onto a 1 hour chart, you have this, you know, this sell side liquidity pool here. You see from this these lows connected to this low, that's a equal bottoms, right? Equal lows. There is sell stops resting beneath there. Now, on these specific news events, NFP and the FOMC, you are not framing the moves into arrays, you're framing the runs on liquidity pools. Make a note of that because some people they focus too much on the idea of the PD arrays getting touched into, right? The first thing you have to consider is the run on liquidity. And after the run on liquidity is offered, you are then framing the use of the PD array matrix to frame your trade ideas. And I want to make a specific video on that, right? Now, if this was the true move, how would we know, right, as the more informed traders, how would we know that this is the real intended move in the market? You would get a breaker, not this. Now, you would get something like this. So let's say it was this. You'll have this high. Before the run up to the news event, they would run that high and then go lower. They would not create a double top. The breaker, right? When ICT taught the PD arrays, he made it his own language. Now, my study on all his concepts is this. What is his language? Why is it called a breaker? Food for thought. The conclusion I came to is the breaker is the break of market structure. That's what it is reliable for, and maybe that's why he called it the breaker block. Now, a breaker is immediately, connected to a reversal. Every reversal has a breaker block. You cannot have a reversal trade without a breaker block inside of it. Now, is there a breaker block here? No. Why? Because we did not run these highs, sorry, and then go lower. We created a liquidity pool and then we moved lower. So when that happened, what was I saying, in real time on the Zoom? I said the market doesn't top like that. We will come back and we will take that high. all those highs. That's just a buy side liquidity pool to induce retail traders into that idea that this is a resistance, a double top, right? And then what happens? In the same, an hour later, they come and they punish that high, right? They run that high by many points on the DXY. On the Euro USD, it's the same here, right? The Euro USD, it runs higher, takes out all the buyers, takes out all the sellers, and it triggers all the buy stops, sorry, and then it moves into the intended direction, right? This move would have been very difficult in real time to anticipate. It's the DXY that tells you that this is clear because the DXY created equal highs, right? Here, there is not really the equal lows to contrast to the DXY. This is why, and there's many of you that send me when a trade potentially hits stop loss and you tell me, you know, I entered early here and then it went in my way. The reason is because you're not looking at the DXY when you're trading the Euro USD. There could be a small lag between the DXY and the Euro USD. The relationship is not 100%. It's a very strong negative correlation, but it's not a perfect negative correlation. The Euro USD could run a bit more before the DXY retraces. This is why you have to look at the DXY. When the DXY is ready to move, then you are looking at the Euro USD, right? Now, touching on this move, if we go to a 1 minute chart, because I know there's some people, and you may not listen to me when I say don't trade these news events. The news event was at 2. This candle on the 1 minute, right? This candle is the drop of FOMC. This is at, 2 p.m. New York time. This is on the 1 minute. There is no way on a live account you would be able to participate in this move unless you were in from before. But if you were trying to press buttons at the release, you would not get involved in that move. Let's say you were shorting this pair, the DXY, hypothetically. We won't. We will look at the Euro USD and we'd long, right? If you're trying to short this on a live account, you would not get the position that you wanted to. When you're trying to sell in this candle on our MT4 retail platforms, you would get entered down here. You would get slipped, and that's what happens. There will be slippage, right? Now, many people not in this mentorship, they actually try to entertain these news events, and what happens is they get crushed. The reason is because these news events are not designed to be traded. FOMC, NFP, and I'd even consider putting CPI into that bracket, but CPI being the most least significant out of the three. They are not to be specifically traded. Now, CPI, you can frame trades around it, but specifically FOMC and NFP, you are letting those dictate the directional bias for your higher time frame. You're leaving that day to then get in line for the next days after that news event. Not every event needs to be traded. Sometimes you let the event pass to get a greater insight of where is the next day then likely to go, because that news event is likely going to offset the intended move of where they're trying to take it. And then you get in line the next days. Many people lose their accounts, and the reason is because they don't trade when it's clear, and they don't weather the storm until the sky becomes clear. You need to know when not to trade so that when it's clear, you have an account to trade. Many people blow an account and then a week later they see the best market conditions that they could, potentially trade. A lot of conditions are easier than some conditions. I'm not saying that not every condition is tradable, but objectively there are some more favorable conditions than others. In my opinion, a consolidation tight range is not favorable just because of how quick they can snap and change, right? You want to be involved in a clear move, a reprice above a high, like this, right? If this was like a 4 hour chart and you have this high and these highs to work for, and you see that you have this low and then that displacement higher, you know what you're working towards. And on the 4 hour retracements, like to this fair value gap, into this fair value gap, you're just framing, 5 to 15 minute long positions up until your drawn liquidity, which would be these equal highs. But some people don't wait for that. And it's a psychological barrier, not so a technical problem, right? Now, next week for the elections, we're going to experience the same thing for the S&P 500. Be very cautious. Now, the S&P 500 on the higher time frames, this is what I have. So if you go for the weekly chart, right? If you have that weekly chart, right, we moved up into here and we have we're moving up and now we're taking out the candle's lows. We swept the previous week's high and now we took out the previous week's low. If we go to the daily chart, right, if I remove this, right, that was a sweep on the previous week's high. That displacement, this is a breaker block and this is a fair value gap. Now you see how Friday came back into the fair value gap. We're trading inside that breaker and now we're moving away. Now we have what on Tuesday? We have the elections. So if you see that Monday's consolidating, you can expect this candle's high with the elections to get swept, potentially to go lower. See how Monday trades and how Monday's opening is and the close of Monday. Because if you are close, and listen here, this is the easiest way to frame a reversal with news. Bearish context, right? And you're close to a previous day's high, and there's a news event. You can anticipate a run on the previous day's high to then reverse lower, given that you're close to it. If you aren't close to the previous day's high, don't anticipate a run on it. For example, Monday opens up and it consolidates around here and closes, you know, around here. Tuesday is relatively close to this candle's high. We can sweep that to go lower, right? Where? Have this as your target first, and then we're going to make our way back to 3,500. Now, the last thing I want to touch on before we close this weekly commentary is the idea of divergence. So if we go to the 5 minute chart, if I just let me just clear this entire chart to make it easier for us. So this was Friday, Thursday. Now this is the FOMC, right? It was on the 2nd of November at 2. Now consider this, right? You see how we did not take out that high. We took out these highs and we ran into the optimal trade entry, the market structure shift, and we could touch on that. Consider this high, right? How this high did not take out that high. Now let's go to US 30. This high took out this high, right? Now let's go on US 10. And you see how this high did not exceed this high. So how do you use a divergence? You need correlated pairs. So for example, the DXY, the Euro USD, and the GBP USD, they're three correlated pairs. That you need a triad of pairs. There's a triad of indices as well. US 500, US 30, and the US 10. Now, how do we use this divergence? Why is it good? Why is it that US 500 didn't sweep that high? US 10 didn't. US 100, sorry, not US 10. But US 30 swept that. What does it show? Which pair is the one being manipulated? Which pair is the one more likely to have a presence of smart money participating? It's this. This is called S&T divergence. Now, you're looking at the US 500, right? For the currency pairs, you'll be looking at the DXY. You're looking at the US 500, and you know already if you're anticipating higher or lower prices. Now you see that the US 500 runs into here and it's offering, just a run on stops to go lower. You look at US 10 year and it's offering the same. But you see, you're looking at US 30 and it ran the high, right? You see how it ran the high. Now, what does that show? Which one is more going to be more better for shorting? Which is going to offer greater short positions? US 30, you're going to be looking for it. Why? Because there has been that run on stops, right? This is the one that they are trying to push down, right? Now, when they have run the buy side liquidity here, it's not shown in US 500 and it's not shown in the US 100. There is a divergence amongst the pairs. Which one are they manipulating? The ones that they're running liquidity, the ones that they are going one way to go to another way. A purge and revert on buy side liquidity, essentially, in this case, right? The US 30 offered that run on the high. Now, what does that tell you? That tells you that out of the three correlated pairs, US 100, US 30, and US 500, this is the better one to look for. Your short positions. Why? Because there's been a run on the buy side liquidity pool, right? This is the one that you're trying to look to trade. Now, how would that correlate to the dollar, Euro USD, and the pound? You'll use the DXY how you use US 500. That is dictating whether you're expecting higher or lower prices. Now, if you're anticipating higher prices on the DXY, right? Now you see that DXY made a you know, let's say the DXY made a higher low, right? Let's say it made a higher low. What do you expect for Euro USD to make? If this made a higher low, you expect that to make a lower high. But if pound made a higher high and then comes down, essentially a breaker, which one shows out of Euro USD and the pound, which one is more favorable to trade for short positions? The pound. Why? Because the pound ran buy stops and the DXY is bullish. The DXY didn't have that run on stops. The DXY showed that it made a higher low, Euro USD made a lower high, but GBP USD made a higher high and then reversed. So essentially, let me draw it out for you so you can understand. Let me remove these drawings. So the DXY, something like this, right? Something like this. The DXY, the Euro USD should make something like this, right? Right? It should make this makes a higher low, this should make a lower high. But then pound does this, right? So if I label this, just to make your notes easier for you guys. You're looking at the DXY. The DXY is always telling you where these two pairs look. You're not looking at this and then the DXY. This is the order you're looking at it at. This is the order I usually look at it at, right? The DXY to Euro to pound. Now the DXY is bullish, so it made a higher low. Euro USD made a lower high, and that's what you expect. If the DXY makes a higher low, you're anticipating Euro USD to make a lower high because they're correlated. But the pound, what does the pound do? It doesn't make the lower high like Euro USD does. Given the same correlation to the DXY, it makes a higher high and then makes the lower low. Which one should you go into trade? Which one should have your attention? It's the pound. Why? Because the pound ran buy stops. There is a greater, you know, opportunity to find short positions. Because there's been that run on buy stops, there is a greater tendency for short positions now by smart money into GBP USD. That's the one that you should look to frame your short positions. This is when you'll look at the GBP USD with the DXY. And that is what happened with these three pairs, right? The US 500 made a lower high, right? Now these three are all positively correlated. They're not inversely like this. US 500 made a lower high, US 100 made a lower high, but US 300, US 30 made a higher high, lower low, the breaker, reversal. This is the key to your reversal trades. If offered, it's not always offered. A lot of the times they move in conjunction to one another. But if you're hunting a reversal trade on Euro USD and GBP USD, consider this because this is going to tell you which one is going to offer the best reversal profile, right? Now, there's been a lot in this weekly commentary, so let's just brush over what is anticipated. Remember, we want to see we want to see this candle get treated as a bullish order block. If we find the willingness to move higher from here, we're framing the move to this buy side liquidity pool, right? Now, it's in a consolidation, so remember, it is a great uncertainty. There is no one-way willingness yet, especially where it's at. You see, when we are at the 50%, we're like at the midline, around the middle of the consolidation. There is no certainty of where it's trading. It is at the equilibrium of the price range, right? Just from eyeballing it here, you can see in this whole consolidation here, we are around the 50%. Now, if we treat this discount order block, right, this discount order block, we find a willingness from here to go higher. We then move our attention to, okay, we're respecting this price array. Where is the willingness? Where is the market going to reprice from here? Remember, take these 3 points. I consider these 3 points in my trading all the time. Where is price right now? Where did it come from? And where is it likely to reprice from here? Where is price right now? Price is at a discount order block. Where did it come from? It came from the premium of the range. So if you find rejection here, where is it likely to reprice? Buy side liquidity pool, which is here. Consider this up close candle as well before the run on this buy side liquidity pool. That's what we're anticipating. Now, using that, you can go and find what we're anticipating in the euro, the same thing. And the pound is pretty similar. There is a small fair value gap in between this candle's high and this candle's low. So you can frame that move, that run on this candle's high into that fair value gap to then go lower. Let Monday play out. See what the profile of the week is going into the US elections, and there is also CPI, I'm pretty sure. Yep, on the Thursday there is CPI. So Tuesday, a news event, Thursday, news events as well. So that's going to be it for this weekly commentary. Any questions, make sure to ask me, right? If you are still unsure about the divergence, replay the video because that is a very good way and a breakdown, probably the better breakdown that you'll get if you try to YouTube it. For the people that are trying to YouTube stuff that is in this mentorship, you will not find this on YouTube. Yes, ICT has its core content on YouTube. It is bog standard to the level I'm going into, right? The way that I've been teaching you guys is what I've learned and my further studies on the matter. So you're going to get way more from this than anything on YouTube. Anything other than ICT, you won't even get close to the content in this mentorship. That's not with arrogance. That's the truth, right? Any questions, ask me, right? Sometimes you guys ask one another, and maybe the answer is not satisfying. Remember, I am always one message away, and I find time to reply to all of you. So on that note, I'll see you guys in the next video, and take care of yourselves.